Hello and welcome to Econoday Unplugged on Tuesday, the 28th of April 2020. Mark Pender is stateside and I'm Jeremy Hawkins here in London. It would be nice to start this week with some good news, but at least on the economics front, that continues to be in short supply. Unprecedented, record, all-time and historic are now well-worn terms these days, and unfortunately, they invariably precede something to do with economic weakness. Proving the point, April's flash PMIs, which for many countries provide the first real guide to how the great lockdown is hitting national economies, made the already dire March readings look almost good. The three central bank meetings this week, and while the raft of policy announcements made last month may mean that investors are not quite as focused as normal, they could still yield some additional help for financial markets. Yesterday, the BOJ opted to remove the upper limit to its purchases of bonds, and next up is the Fed. So, Mark, how grim have your figures been your side? I see we've got, first quarter GDP tomorrow, and should we expect anything new from the FOMC?
Well, I guess that was a pretty good description of lumping together all the words we're tired or we're running out of. Yeah, it's colossal. And that's a funny word because it has a bit of a humorous tone, and you have to have a dark sense of humor to get much of a laugh out of what we're seeing is a gigantic collapsing in economic numbers. But we just had consumer confidence today. It came in the mid 80s. It had broken down below 40 12 years ago in the financial crisis. So there is one report, even though it's the current conditions went down more than double, just went down in half. But there the theme is, and we're seeing this in sentiment surveys everywhere, is the separation between current conditions, which is catastrophically low, and hope springs eternal. And people expect, and I think reasonably so, that things will begin to improve as the lockdowns ease. And it'd be hard for them to get the conditions to become any worse. We're going to get GDP, as you mentioned. The Econoday consensus is minus 3.7%, which doesn't sound that bad. That would be at an annual rate, but that just reflects only 1 month, and really not even a full month in March of the shutdown. So what that will then become into the second quarter is, of course, an unknown. It's still playing out. And then we're going to have employment a week from Friday. And I don't know we don't have a consensus yet on that. The numbers are going to be, unprecedented.
Have you got a new word for that one?
We don't, where is unemployment going to go? Is it going to go into the 20% area? Is it going to approach the 30% of the Great Depression 100 years ago? Or is it, and where is inflation going to go? We had an interesting number today in the consumer confidence. We had a large, significant spike in inflation expectations. Now, this is an April report that includes the total collapse in the price of oil, let alone everything else. Maybe the consumers are just looking at what they're paying on Amazon or whatever for their stockpiling, and prices seem to be going up. But that was a real surprise for me.
To interrupt, that's interesting because it seems to be in quite sharp contrast to what we've seen in Europe. And we had, we're just taking the UK, we had the Confederation of British Industries, a sort of survey of the retail sector out earlier on this morning. And they found, looking at internet sales, the first negative reading on that since the survey was first put together. And in the inflation numbers we had out last week, again, we actually saw underlying weakness coming through. So it's quite interesting. We appear to have, underlying deflationary pressures in Europe, but you're saying expectations your side of the water is going the other way.
Well, this is just one reading, and it's a difficult one to judge. But we had Redbook today, which is a weekly same store chain store indicator for it. Basically, it tracks essentials, basic goods, and it's sharply lower. It peaked out almost double-digit growth for a month as people stocked up, and now it's coming down almost in the double digits. So it does look like the retail sales are going to go down. Of course, there's going to be so many dislocations in the data Jeremy. It's like we had inventories today, and retail inventory shot up higher in March because of the close down of car dealers, and that made for a big, huge build that's going to offset a big, huge draw at the wholesale level. So the numbers are going to be hard to figure out. There's going to be odd cross currents, and like these PMIs and the composite indexes. I just want to personally say that delivery times do not belong in the composite index. During a crisis time like this, when you go back and you look back at these composites, they're not going to make sense. They're actually stable, or the ISM, for instance, here in the U.S., because of the gigantic spike in delivery times, which isn't a positive at all. It's, and so that's an example of the kind of data confusion that we're going to be getting.
Yeah, I think you're exactly right there. And I think particularly when we're looking at the likes of the PMIs, it's going to be, obviously the current output measure, which gives you, for all intents and purposes, a respectable view, but also orders. But as you say, things to do with timings and such are going to be completely messed up now. Anyway, what about the Fed? Is there anything expected out the FOMC this week? Is it all done?
Well, they announced yesterday increasing support for the muni market. And what else can they really do? I'm a bit of a skeptic. I think that the value for the market moving value of central banks are in the past right now. They've pulled out all the stops, I guess, except for the ECB. And you did a write-up on them, which was I found very interesting. But it's and their lack of relative of programs. But the Fed has done everything it possibly can, and I'm sure that they're going to give us some kind of odd economic outlook. But it's hard to say what what those outlook will be. But let me come back to the ECB now. You were stressing the comparative lack of support for the markets and banking. However, could it play into Europe's advantage if this virus turns out to be, if we do have the easing lockups and we don't have a spike again in infection rates, could the ECB actually come out looking good?
If that were to be the case, and I suppose it's certainly possible, but I think the general sense here is that although, as you mentioned, we do have some very cautious easings of the restraints on people moving and restrictions and so on, but by and large they tend to be very narrowly based in terms of just certain types of retail areas, certain types of manufacturing. So in terms of actually trying to get the whole economy per se back to working again, that I think is still some way down the road. And even now, I think there are countries, the UK classically being one, also France to some extent as well, which are kind of looking over their shoulders at those countries which are already starting to relax the containment measures just to see what happens. And it's interesting because we've had some, again, very loose easing of restrictions in Germany, but we had some official data coming out of the Germany's Robert Koch Institute earlier on today. And this is looking at this so-called reproduction figure, which is effectively looks at how many people one person with coronavirus might infect. And the golden rule there is you want to get this number down below 1, because if it rises above 1, it means that one person can infect more than one person. If that continues for long, then you're talking about exponential growth of the coronavirus. In the case of Germany, they thought they had it down to around about 0.7%. If they can keep it down there, ultimately it should mean the virus would be eradicated. But according to the Koch Institute, they think it's risen back up to 1 again. Now, whether or not that was due to a partial relaxation of the rules or the restrictions last week, or it's just nothing to do with that, we don't actually know. But I think it's the kind of message which sends to governments all around the world, and Angela Merkel is still very keen on this. The relaxation of these restrictions has to be very mild. So in terms of the ECB, I think it's highly unlikely that they'll be able to stop where they are now and think that's a done deal, particularly because excuse me, in contrast to what's happening from your government, the European Union as a whole is still simply not delivering. So, for just talking about the ECB, last Thursday we had a meeting of the EU leaders and finance ministers, which was supposed to be getting down to the details of a package, an emergency package of measures worth at least €1 trillion and possibly more than that. In practice, as is often the case with these European leaders, they couldn't come out with a full agreement. The bottom line is that there are big differences between Italy, France and Spain, who are proposing the use of grants to fund the bloc's economic recovery, while the sort of the hawkish members like the Netherlands and Austria insist that these grants should only be in the form of loans. So ultimately they came out really with nothing last week, apart from agreements defer the next set of discussions until the summer. But they just signed off on the April the 9th package, which was worth 540 billion euros, which is small fry compared to what the likes of the White House has been doing. So I think there's ultimately it leaves really the ECB with more pressure on them to come and try and make up for, if you like, the shortfall in the policy response from European governments. Now I think going into Thursday's meeting, because the ECB did introduce 2 packages in March, although neither was really, I don't think, significant enough, probably expectations for this particular Thursday aren't that much. But I think there is an underlying belief amongst investors that at this stage they simply haven't done enough. And when you look at what's happening to the Fed's balance sheet, which is almost going up in a straight line at the moment, yes, and what the ECB is doing with it, you've got to think there's an awful lot more the ECB could do if it wanted to. So I think we'll probably get some tinkering like with some of the targeted longer term repos and this sort of thing. But in terms of another big package at this stage, no, but yes, I think they will do something later on.
Well, let me get back to my original question though. If there is not a catastrophic breakdown in a GDP in Europe, will this prove to be a net positive for the euro relative to the lack of fiscal stimulus? And you were talking about the White House and the 2.3 trillion from the Fed. It's hard for me to imagine these things being positive for currency values. But the euro, I mean, could it be? And let's say we get a very positive. If it's possible to get a very positive outcome out of this, would the euro stand to gain?
It may do. Well, I suppose my starting point would be that I think a positive outcome at the moment looks very likely. And just to put that into context, you're talking about you have your first look at first quarter GDP out the States tomorrow. Mm-hmm. Well, we get the so-called preliminary flash estimate of Eurozone GDP for the first quarter on Thursday. So this is their equivalent, their first look at it. Mm-hmm. Whereas your call, was it down? Was it just over 3%?
3.7 with the low at 7. No, wait a minute. You just said
annualized. But that's
right.
Annualized.
That's annualized, right?
Yeah.
But wait a minute. Which outlook? You said likely, and I thought you meant unlikely for the outlook. Positive. Yeah. What's your outlook for Europe?
For Europe is still negative. I mean, the market call on first quarter GDP is down 3.1%. That's quarter on quarter. So you're talking at over 12% annualized rate, to put it in US terms. Mm-hmm. And interestingly, we had ECB President Lagarde. Now, she was allegedly quoted, and it hasn't been officially denied by the ECB, that she could, on worst case scenario, because it's worst case, but it's part of their scenarios they're looking at now. She's talking about a possible contraction in total output in the Eurozone this year of some 15%. And that is a huge decline. The IMF in its forecast was was looking for about down 7.5%, if I remember rightly. So I think as things currently stand in Eurozone at the moment, it really doesn't look good. It's very hard to find any good news anywhere. So the hope has to be that these gradual easings of restrictions will allow output to start growing again. But it's going to be growing from such a low base that the actual level of output itself is going to take probably, I suspect, a very long time to get back to where it was at the back end of last year.
Well, let me ask you, I can't find any indications right now. We had the auto shutdown in the auto sector. We had shutdown. We have the 737 Boeing failure, which pulled down durable goods by almost 15% in the month. But as far as the assembly, elbow to elbow work in construction, elbow to elbow work in manufacturing, and these kinds of things, I haven't really seen. I'm keeping my eyes open for a new paradigm or something on these activities. Are you seeing anything? I mean, it'd be nice if we just had all robots, I guess. But,
well, it may well be. Ultimately, perhaps this is something which will push the drive towards, the AI technology and so on. But no, I think on the whole within Europe, so much of industry and services has just been simply shut down. So there's very little good news to find anywhere. Apart, and even then you've got to be careful, trying to find the equivalent of your expectations improvement. Well, last week I think we talked about ZEW, where we saw analysts becoming cautiously positive, at least about the outlook for Germany. But then back end of last week, we also had the latest EFO survey, and that, to all intents and purposes, was looking at record lows right across the board. So it's hard at the moment, I think, within Europe to find even expectations which are improving, bar the fact that, of course, as far as the stock market's concerned, I think they are taking the long-term view that there's so much being thrown at the global economy that at some point it's going to have to turn up.
Well, this reminds me. There was, the business press has a very lack of imagination when it comes to images. So if it's a trade story, they'll show you, a dock, a crane or a container, and if it's a I'm sorry. I pick it up right now. I lost my keyboard. Hang on. And so if you remember, the classic image of the stock market were traders, and these were images. I won't name any of the news agencies of the New York Stock Exchange. They were still clumped together in mid-March. So you'd have a picture of traders looking puzzled with their hair all frizzled out, and that kind of, just every picture is exactly the same. Well, then one day in mid-March, you didn't see that picture anymore. They finally wised up that they can't all be clumped together like this. Now, and that's what my whole point is with manufacturing and construction. Is there going to be a new way to do things? Now, I think part of the idea that our infection rates may be going down or won't be going up as much when easing is because everyone's standing 6 feet apart. And so there's a new kind of a sensitivity to that, and maybe that will help contain the virus. But the economy itself and the way things are done, the way goods are produced, I think will have to change, and that's going to be part of what we have to do. We're going to have to start, paying attention to this, and the manufacturers are going to have to start doing something. Otherwise, they're going to be like healthcare workers. They're going to be standing in line somewhere, and a certain number of them are going to be getting sick, and that's just,
I think you're right. Yeah, in fact, we had to look at the latest photographs coming out of Wuhan, where you've got the workforce going back to work in some industries just wearing hazmat suits, and even then standing however far apart as they regard it as being appropriate out there. So, I mean, the bottom line to all this is still that productive potential as we foresaw it in the past is going to be nowhere near that in the future until such time as we actually get people properly back to work and be able to produce as efficiently as they were before. Economic growth is going to be that much less, national income is going to be that much less, and so on and so forth.
Yes.
So it's going to be a very difficult time.
A structural change in man's economy. And let me just say something about the PMI. Now we're going to get the Chinese PMIs for April. Kicks in the beginning of next week, and the economic data out of China was improved, or it stabilized from the collapse in January and February, which gave us hope that our pattern would be the same. But so we're going to get their April numbers. Now, how big of an effect has the drop in Europe and North America been on their economy? So what do you think about that?
It's got to be important. I think if we go back to what the global financial crisis, for some while it looked as if Japan was actually going to do relatively well and outperform the other, if you like, the G7 countries. So their domestic demand seemed to be doing all right, and GDP was holding up that much better. But in the longer run, because Japan was so based, and it still is so based upon export demand, as it started to see its markets drying up overseas, so then it got hit, and it got hit hit really badly. And so in the end, it turned out to be one of the worst performers of the lot. And I think we're going to see the similar sort of thing in China. Okay, they've got potential domestic demand out there quite clearly because the consumer sector is so big. But nonetheless, they're going to struggle to grow at anything like a decent rate if they can't export to the rest of the world, because that's not growing.
Mm-hmm. Oh, and okay, now let's turn to the financial markets. And we've seen this incredible rally in the stock markets. However, if we remember back in September here in the U.S., and the liquidity scare in the repo market, and the lack of lending, and the Fed, I think, put in something like $400 billion at least into the banking system, and that was essentially, or that helped, or there is the argument within the Fed that this money ended up in the stock market. Now, is what we're seeing now, with all this global liquidity, just ending up again in the stock market, driving up values, and is this a possible danger?
Well, I think the answer has to be yes. And at the end of the day, if you look around the world and see how much domestic demand there is, well, let's be honest, there isn't a great deal of it. So this liquidity is clearly going somewhere. Now, some of it will probably end up back at the central banks, being parked there by the private sector institutions we saw previously. But I think, yes, a lot of it's got to go into, well, some of it's going into the bond market. I know we've had wobbles in the bond market, but some of it's almost certainly going there. But I think a good chunk of it must be going into these equities. And we go back to the case, well, perhaps if you believed when you had, before the crash that we've had so far this year, prior to that perhaps equity markets were already rather overcooked in terms of where the fundamentals lay. Well, you've got to think now, given how far they've come back from below, but what's going to happen now to the fundamentals? Well, it's looking increasingly frothy. So I think at some point it does seem that these things are going to come down. But that may well be in the future, somewhere in the future, simply because there's so much money out there sloshing around, trying to find an asset somewhere. Mm-hmm. And when you've got interest rates negative almost everywhere now, where's it going to go?
Well, how about the UK housing market? What's your thought on that?
Well, the UK housing market was doing well after we had the December general election. The numbers from the surveys for January and February, and to some extent even March, actually looked half respectable, and it did look as if the UK housing side was starting to turn around quite nicely. The problem is now, as the lenders themselves are admitting, effectively the government's come out and really asked people, don't move. Basically, don't move at the moment until this coronavirus is sorted out, or at least until conditions improve a lot, which means the lenders aren't lending anything. There's no transactions going through. So you talked earlier about trying to interpret the data. Well, in many ways, the UK housing market, there isn't any data anymore because no one's moving anymore.
What does that mean for prices? Are they going to hold steady? Are they going to go down?
Well, prices, I think no one really knows. What is a house price at the moment? And the answer is, well, we don't know because no one's bought or sold a house. So, I mean, ultimately, I dare say there'll be pent-up demand, which may help to push prices up. But in terms of, where we actually stand at the moment, no one really knows because there's no data to actually price off in the first place.
Well, let's hope the data keeps coming out. You had a scare, the Italian business and consumer report by Istat. It was delayed. Is that right?
It was, that's right. Due to the coronavirus, apparently they're unable to actually compile the data. I think, as I understand, at the moment, ISTAT are just maintaining that was only for April, and they hope to have the figures of the surveys up and running again for next month. But clearly, this may be a warning shot across the bows, and it could well be a taster of the kind of things we have to come. Of course, for financial markets, it's particularly bad news simply because the surveys come out so far in advance of the hard data themselves, and they really look at those, like the PMIs, to try and judge what the heck is going on.
Well, we haven't seen any actual cancellations of any data here in the U.S. The regional reports, for instance, the Kansas City Fed or the Richmond Fed, their samples are small to begin with, 100, 200. It could be, and and the Census Bureau keeps telling in their paragraph introducing their reports for the last month that businesses, there's lack of contacts, businesses are shuttering, and so it makes me wonder. We're seeing all this volatility in these other numbers, including this includes all the PMIs, and also some of the sentiment surveys as well that aren't telephone sampled and aren't in the thousands. I mean, there is a risk. No one's canceled their reports yet, except for the one we just mentioned. But you have to wonder. I mean, it will. They don't tell. They just say, it passes our minimum or our requirement. For what data quality and quantity should be. They don't tell you what exactly that means, but is there going to come a time? I don't know. Maybe it never will if we reopen that, and the data will continue to come out. But that's something to keep an eye out for, I think.
No, I think you're exactly right. I would say if this thing runs on, then you've got to think the quality and reliability of data is going to be a major issue, and it wouldn't surprise me at all if it gets to the stage whereby some traditional, let's say, monthly economic reports are simply no longer produced, so that more focus can be attached to the ones that the policymakers will regard as being the most important.
But they could not put out a U.S. employment report, even if
no. Well, I think
their minimum requirements. They would just have to estimate it, right?
But perhaps, for example, they might not put out a U.S. PPI report or something like that. So I don't know. Who knows? All righty. Okay. Well, I suppose we've spoken quite a lot about numbers. It's probably about time we called it and then end into it all there. One thing I will say in terms of looking at these numbers, we had a bit like your side. We had UK March retail sales out last week, which, surprise, surprise, saw a record 5.1% monthly decline. But within that, alcohol consumption was up 30% on the month. And as a beer drinker, I'd like to think I'm doing my bit to keep that side of the industry going.
That's right. Keep prices up.
Okay, that's it for today then. Mark and I will be back next week, and joining us will be our Sydney-based economist Brian Jackson, who will provide an update on developments on his part of the world. So do join us then, and in the meantime, thanks very much for listening, and remember to keep up to date with all the key data and events in Econoday's global economic calendar. We'll see you next week. Bye for now.